Hey everyone, my name is Corey Stackhouse. Welcome back to the Stack Enterprises YouTube channel. In today's video, we're going to discuss 20 different ways that you can get your money out of your retirement accounts prior to age 59 and a half and avoid that dreaded 10% penalty we have all heard about on retirement accounts. Now, whether you're interested in early retirement, have an unexpected expense come up, or just want to know your options, today's video is going to be a good guide for you. With that being said, I am a certified financial planner partnering with my clients on their financial plans and their tax advice. Please make sure you consult with your trusted financial advisor, your CPA, your legal counsel, whomever it may be that you discuss these concepts with to see if it's going to be applicable to you. With that being said, if you are interested in a company or myself reaching out to introduce ourselves to discuss these concepts, our contact information is in the description below. Now that we've got that disclosure over with, let's get on to the video.
All right, so we have a lot of information to unpack, so I'm going to organize it for us at least a little bit. So there are 20 different ways or 20 different concepts that we're going to discuss briefly inside of this video. I'm going to organize them into 6 categories. These categories are going to pertain to employer-sponsored plans, life events, financial hardships, corrective distributions. There are going to be a couple special financial strategies, and then lastly, an employee stock ownership plan option that you have. So before we dive into each of those categories, I want to make sure we're all on the same page with what a regular aged distribution is from a employer-sponsored account or an IRA. So in the scenario that I've drawn up here, we've got John, who at the age of 60 wants to pull money out of his IRA to live for or to use for retirement expenses sake. With that, every dollar that he pulls from that IRA is going to be treated as, for tax sake, ordinary income. So if he pulls out a chunk of $30,000 throughout the year to offset his income needs from that IRA, he's going to pay taxes on $30,000 is the short version. So talk with your tax advisor about this a little bit further because there are some deductions and that sort of thing. But in short, if you are over the age of 59 and a half and you take distributions from your IRAs or your employer-sponsored plans, you're not going to have to worry about any 10% penalty or anything along those lines, just the taxes that would be incorporated with those account types. The first category, again, of employer-sponsored options that you have for taking distributions from your IRAs prior to the age of 59 and a half and without any taxes is the first one. Actually, the most uncommonly known to me is what I found in my office, at least, is the rule of 55 that is applicable on employer-sponsored retirement accounts. So in this example, let's assume Lucy, who is age 55, decides that she wants to retire early because she has done a fantastic job of saving for her future self. She is going to be allowed to take distributions from that 401k without the 10% penalty that you hear about with taking distributions prior to the age of 59 and a half due to some special tax code around the employer-sponsored plans that are offered for early retirees. That is the first way that you can get your money out of your employer-sponsored retirement accounts prior to age 59 and a half without any penalties associated to it. Next option I'm going to point out is on 457. These are normally offered to local individuals who work for local government agencies or not-for-profit organizations. Your age is actually going to be reduced all the way down to 50 is when you could hypothetically decide to declare retirement with that employer and move on to something else or live your retirement years out and not have to worry about taking a 10% penalty for early retirement withdrawals. So those are the first two of, again, 20 different ways that we can get money out of our retirement accounts without paying penalties and prior to 59 and a half. If we continue on, there is a phased retirement option that is now becoming more and more common with employers where someone, for example, Elaine, who is 58, who isn't quite retired yet, would have access to a phased retirement program that is offered by the employer. Talk to your HR department to see if this is something that's applicable to you, but it is becoming more and more common as we go through the years because individuals are considering part-time work to help with that transition period from working full-time 24/7, it feels like at least, to cold turkey stopping. It helps you with that transition period and helping out with income gaps if you haven't quite saved enough into your retirement accounts. Again, she is not going to be having a 10% excess tax or anything on that on top of these distributions from that plan that is offered by the employer. All right, so next category, of the 6, this is the second one, life events. First thing that we're going to talk about is death. I'm being really morbid here, but in short, if somebody inherits an IRA, those are going to be called inherited IRAs or beneficiary IRAs, depending on who you talk to. But let's assume that Linda, unfortunately, at the age of 50, passes away and her son inherits the account. Well, the son is the age of 30 and he is a non-spouse. It's a little bit different for spouses. You kind of inherit those as to your own age. So if Linda was married to Gary, for example, and Gary was 53, he would inherit the IRA, assuming she listed him as beneficiary, and it would become his own. That he would then be he would have to follow IRS tax code about RMDs in the future and taxation. But let's assume a non-spouse beneficiary, so a son, for example. He would actually have the opportunity of taking all that money out at once if he wants to, or he can take it up over a 10-year period, or there is an opportunity sometimes in some unique cases to take that account out over the required minimum distributions of the beneficiary of the account. I won't go down that rabbit hole today, but according to IRS tax codes, it changes from year to year. But in short, there are no 10% penalties for pulling monies out of inherited IRAs that you receive from the unfortunate event of somebody passing with you being the beneficiary on those accounts. You are going to be taxed on those dollars just like you would a regular IRA, but know that there is not going to be any penalties or fees or any age requirements of you having to wait until age 59 and a half yourself or anything of the sorts. Now, next scenario that could come up would be a disability. Let's assume Robert, at the age of 45, suffers a life-altering event that he is now declared permanently disabled. He is going to have full access to his retirement accounts to pay for his living expenses for whatever he needs while he is left on this planet. There is not going to be any 10% penalties on it either. So those, unfortunately, are two bad cases. I've got a couple of others that could come up, but this one, a domestic relations or a divorce in short, can be used in a couple of different ways. So this case, we've got Emma, who is going through a divorce with her husband. As part of the settlement, she's going to get half of his 401k. Let's just assume they're in the state of Missouri, because that's what I'm very familiar with right now. She's going to be entitled to those proceeds. She can actually take money out of those accounts without paying penalties on those dollars either, due to the domestic relations situation. Now, there are, and you would need to talk to an attorney about this, so please do this if this is something of interest to you, or contact, again, a financial professional or somebody of the sorts to see if it's going to be applicable to you. But I have heard of use cases where individuals might, on paper, get a divorce in order to be able to have access to retirement monies, maybe to go buy their dream home for whatever it may be down the road. And let's assume they get back married after the fact, or maybe wait a certain amount of time to make sure that there isn't going to be any red flags on the situation. But it would be a strategy that I know I've heard of individuals in the past utilizing, to where they would get a divorce prior to the age of 59 and a half, so they could have access to the retirement monies that they've been saving all those years, so they can then go buy property or whatever it may be that is going to be one of their financial goals, as in their case. Another way that you can have access to your retirement account monies or your IRA monies is going to be paying for education. So let's assume Maria wants to pay for education for her daughter. She can go ahead and take money out of those retirement accounts to pay for education, again, without paying a 10% penalty. Those distributions, again, would be taxable, but in short, education expenses, the government likes to give incentive for us to continue to promote education and going to college. So you're not going to have any penalties for taking distributions out for paying for qualified education expenses. A few examples of those would be like tuition, fees, books, supplies, room and board, or who are for students who are at least half-time. Now, these rules do change from year to year. So again, please talk with your professional to make sure that this information is going to be accurate and up to date based on the timing of you watching this video. All right, so life events continued, because there are a lot of life events that would allow you access to your retirement monies. If you have any medical related distributions that you need to take care of. So a couple of examples would be Anna. She has a sudden medical emergency with bills totaling $50,000 that her insurance does not carry or does not cover for her for whatever reason she may have. So in the event that her medical bills are going to exceed 10% of her adjusted gross income for the year, so in this example, she makes $100,000, her medical bills are $50,000, that is over the 10% threshold of her income. She can withdraw the extra dollars that she needs to pay off those medical bills without incurring an extra 10% penalty slap on the wrist on top of it. So in order to take care of a medical expense, you can take distributions from your IRA as well. Also, another situation where this could be applicable to you, let's assume that unfortunately you lose your job. In this case, Emily, she's 40. She decides to go to a new employer, and the new employer is a small enough company that they do not offer health insurance to her. She then could use her IRA proceeds to continue to pay for health insurance premiums, whether that's on the open marketplace or COBRA insurance or whatever it may be that's applicable to her. That is something that would be allowable without her paying a 10% penalty on those proceeds as well. All right. Next section, financial hardships. I know we're flying through these fast. Please leave any comments or questions or any additional information you would like for me to go through in the comments below on this video. I would love to make more videos on these topics in the future if they are something that you find value from. But financial hardships, this will be another way that you can have access to your IRAs without necessarily paying a 10% penalty. So let's assume a unfortunate scenario where Mark has a really good year financially. He makes a lot of money, but he all of a sudden has a tax levy. He owes the IRS more than what he had saved throughout the year, and he doesn't have the money to come up to pay that bill. He would have the ability to pull some money out of his retirement accounts and not pay the 10% penalty on those distributions in order to get him whole again for the IRS. So that is something that a lot of people have not been aware of in the past. It is a tool disposable to you. Just know that, again, that income is going to be taxable. So you're going to want to withhold taxes in addition to pay off the debt that you have incurred with the IRS. There are some situations where hardship withdrawals can come into play too. So let's say Raj is 45. He's going through some tough times financially. He might qualify for a hardship withdrawal if, again, he has any medical expenses, or if he has any situation where he needs to help purchase help with the cost of purchasing a primary residence, again, tuition expenses. If he has an eviction or a foreclosure that he's maybe going to have to face, he might be able to withdraw from his IRA in that situation as well without the 10% penalties. If he has a burial or a funeral expense that he was not aware of or did not expect to happen, maybe a spouse or a kid or a family member or parent, whomever it may be, or if there are certain expenses that need to be done to the primary residence that this individual is living in, that is, again, a situation where he may be able to talk with the tax advisor about this, have access to those funds to qualify him for a hardship withdrawal where he would not have to pay a penalty on the distributions of those assets. Okay. So a couple quick points on corrective distributions. So let's assume either Mike or Nina, they both have different retirement accounts. Mike has a 401k, Nina has an IRA. Either one of them, if they over contribute the maximum limits of what they're allowed to into those types of accounts, I believe in the year of 2023, a 401k, the most that Mike could contribute to based on his age would be $22,500 or something around that range. Nina would have the opportunity to contribute up to $6,500 for the year of 2023 in her IRA. Let's assume both of them put more than what they meant to. They can take out those extra contributions without having any penalties or fees because they would be following the IRS tax code, so they're not going to necessarily hold that against you. Okay, that was a quick point. Again, corrective distributions, those are quick and easy ones. I don't know if those really count for the 20, but we'll count them just for the number's sake. Okay, so special financial strategies. Although it depends on who you talk to and how you would consider this, a Roth conversion would be another way that you can get money out of your IRA. Meaning, if you have an old retirement account that you've rolled into an IRA somewhere and you want to go ahead and pay the taxes on those dollars today to have it be converted or put into a Roth IRA where that money can grow hypothetically tax-free forever, that's what a lot of individuals like to consider doing, especially as they're coming up on their retirement years and they're trying to maximize not only what they get not what they make, but what they get to keep at the end of the day for tax sake. So Jane, in this example, she's 52. She thinks taxes are going to be higher in the future. I have to believe that myself. I have all of my personal monies in Roth IRAs. I have to admit full disclosure. Jane decides that she wants to go ahead and pay some taxes on her IRAs to move that over into a Roth. She's in the, for example, 22% tax bracket now. She thinks when she is retired, she's going to be in the 30% tax bracket. Well, she's going to be saving that 8% difference on her taxes in the event she decided to go with this strategy, and she was correct about future tax brackets on herself. Okay, another strategy, net unrealized appreciation. Okay, so net unrealized appreciation may be applicable to you because, for example, Carlos, in this scenario, he has $100,000 of a stock position that he owns inside of his 401k from company ABC. Company ABC had purchased stock for him inside of his account worth approximately $20,000 X number of years ago, and today it's worth $100,000. What Carlos may consider doing is he might consider paying ordinary income taxes on that $20,000 that he has as his initial contribution into that stock in order to pay long-term capital gains taxes on the $80,000 in the future. Why may somebody want to do that? Well, ordinary income taxes may be higher, depending on what his current income is now, than what long-term capital gains taxes would be for him in the future. So let's assume he's in the 25% tax bracket now, and in retirement, he would be in the 25% tax bracket as well. Well, maybe Carlos is only going to pay 15 to 20% long-term capital gains taxes on that $80,000 gain if he was to incorporate this strategy. So I know I'm getting into the weeds with this concept, but talk to your tax advisor about it. It would be something applicable if you maybe have employer stock inside of the 401k that is offered to you. All right, so special financial strategies continued. Due to COVID happening, I know that there's an option to where if you have a birth or if you want to handle an adoption, you could potentially withdraw assets from your IRA in order to cover those expenses without paying a 10% penalty as well. There is also a qualified reservist distribution. So any military personnel, if you got deployed and had to go overseas or whatever it may be for active service, you would also not have any penalties held against you from taking monies out of your IRAs as well. So I know I keep repeating that all of these rules would allow for you to take money out of your IRAs without any penalties. I just want to make sure I drive that home for you. Another opportunity that may exist for yourself, I mentioned it earlier, if you have an old retirement account, an old 401k or something of sorts, and you want to go ahead and move that into an IRA so it's more accessible and liquid to you, there is a 60-day rollover rule, technically. So what somebody may do with this is you could hypothetically cash in your 401k, put it in the bank account. At that time, you have a 60-day time clock in order to put that money either back into the employer-sponsored plan, into an IRA somewhere, into your new employer-sponsored plan, or just leave it there. And if you leave it there, that's where you're going to have to pay the taxes and the 10% penalties and everything else on it because you're under the age of 59 and a half in this scenario. But you have the opportunity to roll it back without having any penalties or fees, and that's what this situation is applicable to. All right, so lastly, employee stock ownership plans. They are a unique type of retirement account. It's where, again, an employer allows you to invest in their company stock. This isn't necessarily inside of the 401k that I alluded to earlier. So in this scenario, let's assume Karen, she's age 40. She works for company ABC, and she receives some dividend payments from her stock that is held not, again, inside of an employer-sponsored plan, but outside into a non-qualified brokerage account. She is going to pay ordinary income taxes on those dividends that she receives from company ABC that she works at. But if she decides to hang on to those distributions, that stock until a later date after she receives it, she could get preferential treatment on those capital gains distributions, meaning it could be treated as long-term capital gains versus short-term capital gains, again, ordinary income. So I hope that helps. This is, again, 20 different ways that you can have access to your retirement account monies, hypothetically before the age of 59 and a half, and without a 10% penalty fee. I hope you derive value from this I hope you derive value from this video. Now let's get out to the outro.
That wraps up today's video on 20 different ways that you can gain access to your retirement monies without a 10% penalty. Please be careful with these concepts. Discuss these concepts with your trusted financial advisor, your CPA, your legal counsel, whomever it may be that you discuss these concepts with, to make sure it is applicable to you. In the event you derive value from this video, please leave us a thumbs up and share the video with somebody who also could benefit from the information. Also, please subscribe. We post videos once a week covering the topics of financial planning, investment management, estate planning, tax planning, life insurance, annuities, long-term care, homeowners and auto insurance, and others. Also, if there are any particular topics that you are interested in, please comment those below this video and I would be happy to oblige to those requests in the future. As always, I hope you have a great day. Thank you very much for your time.